Hello everybody, how are you all doing? What's up? Vanakkam everyone. Hello Dhanwant. Hello Julie. Hello babies. The live is on. How are you all doing? Very good evening, Preeti. Hello Saranya. How are you today? How are you all doing? Have you all come prepared with revision of national income? Yes, I'm waiting for your reply in the chat box. That's wonderful. Keep up the good work. Very good evening, Yamuna. Hello, Faridul. So today we are supposed to discuss the chapter of national income. It's a very easy chapter, provided you pay a lot of attention, provided that the concepts are clear. So today the focus will be on conceptual clarity. Wherever you have a difficulty or a problem, you can just raise your hand. Rather, you can just ask me in the chat box. So, beta, when we talk about national income, can I say national income is the income of the nation? What I earn is my personal income. What you earn is your income. But when we talk collectively about India, then India, we talk about national income. Whenever we talk about nation, please understand that India does not go to work, but Indians go to work, and whatever amount of money Indians make is called as national income of India. A yes or no? So, what is a country? Country is a geographical boundary. India's structure, geographical boundary. In the country, there is population. So, country plus population is called as nation. Now, when I talk about a nation, in that nation, there will be certain economic transactions. So, whenever anything is related to money or finance, we call it as economy. So country plus population, nation plus economic transactions is called as economy. Now income can be of two types. Income can be either earned or unearned. When do we get earned income? We get earned income because of production of goods and services. Because there is an economic activity. And since there is economic activity, we call it as economic income. Whereas unearned income is without the exchange of goods and services. Still you earn that income, then it is called as unearned. So earned means for exchange of goods and services. Unearned means without the exchange of goods and services. If earned was termed as economic, unearned is called as non-economic. Non-economic income is also called as transfer payment or transfer income. So dear students, in national income, only earned parties included. Whereas unearned income is excluded. Why is it excluded? Because it will result into double counting. So we don't want our national income to be overestimated. So while we calculate national income, we only talk about earned income. We do not talk about unearned income. Earned income is included, whereas unearned income is excluded. Yeah, are we all clear? Are you all understanding? Keep talking to me in the chat box so that I know that you all are understanding whatever I am explaining. Preeti, Yamuna, Faridul. Are we all clear? So, what is national income? It is the income of the nation. Why do? But nation is made up of people. Why do people get an income? Because they work, because they contribute in the form of factors of production. What are factors of production? Land, labor, capital, entrepreneur. So what do they get in return? Rent, wages, interest and profits. National income includes only earned, does not include unearned because unearned can result into double counting. Then there is a concept called as economic growth and development. So growth is the rise in output. If output rises, India's GDP will rise. That is national income. Beta, GDP means gross domestic product. If GDP rises, let's assume population remains constant, our per capita income will rise. And if I earn money, will I take money on my chest and go up? I will spend that money. So there will be rise in per capita consumption. So what is economic growth? Economic growth is the rise in output, which leads to a rise in GDP, which will lead to a rise in per capita income, and that can eventually lead to per capita consumption. Whereas when I talk about economic development is equal to economic growth plus economic welfare. When do we get welfare? When there is rise in life expectancy, whenever there is rise in literacy rate, there can be a rise in employment. All these are measures of welfare in the economy. Reduction of infant mortality rate, reduction in poverty, reduction in crimes. These all are welfare related measures. Yes, everybody. Yes, Vasant. So, Vasant, in a layman's language, national income is GDP. But somebody who understands economics, for him, it is NNP at factor cost. So, in the normal language, we say that GDP is national income. Now, national income, what is the formula? National income is price into quantity. National income is the price multiplied by the number of units produced. So if I take an example of the year 2013, price was 100, quantity was 1000, national income is 1 lakh. Cut to the year 2023, price rises to 150, output is 1000. Yet my national income is 1,50,000. And if price is 100, output is 1,500, still my national income will be 1,50,000. So dear students, can I say in case A and case B, my national income is 1,50,000. But I would prefer case B over case A, because in case A, national income is rising due to the rise in price. I repeat, national income is rising due to the rise in price. And in case B, national income is rising due to the rise in output. So what do we want? Do we want the national income to rise because of a rise in price? No, na? Because that would mean that there is inflation in the economy. We want national income to rise due to the rise in output. So when national income rises due to the rise in price, we call it as false growth. But if national income rises due to the rise in output, then we call it as real growth. Yeah, are we all clear? So we go to the next part, that national income can be calculated at current year prices versus base year prices. Either you can calculate national income at the current year, or you can calculate national income at the base year prices. Thank you, Yamuna. Thank you, Vasant. Thank you, Preeti. Preeti wanted a detailed revision of this chapter. I hope you are getting one. Now, if we take the price of the current year and quantity of the current year, then we get nominal national income. But in nominal national income, we have a problem. The problem is that nominal national income can rise due to the rise in price. Nominal national income considers the price of the current year. And since it considers the price of the current year, it can be either inflated or deflated. So do you want an inflated national income? No. Do you want a deflated national income? No. That is the reason why we select the price of the base year multiplied by the quantity of current year. Then national income rises due to the rise in output, which is our real national income. So if you have two options, whether we should calculate national income at current year prices or we should calculate national income at base year prices, which one will you select? Tell me, what is your answer? Yes, everybody. National income should be calculated at current year prices, or national income should be calculated at base year. Very good, Vasan. Lovely. Because current year has the problem of inflation or deflation, which is not the case in case of base year prices. Now there is a concept called as GDP deflator. GDP deflator is NNI upon RNI. NNI means nominal national income. RNI means real national income. So when I calculated national income on the basis of current year prices, my national income was 1,25,000. And as per base year prices, my national income is 1 lakh. So what do I get? I get an answer of 125, which means in our economy, we have an inflation of 25 percentage. Base year index is 100. Current year index that we found out by RNI upon NNI, or rather NNI upon RNI into 100 is 125. So 125 minus 100 is equal to 25 percentage. So 25% is the amount of inflation in our economy, and that is calculated with the help of GDP deflator. Hey, yes, everybody, are you all there? Are you all understanding? Are we clear? Shall I go to the next part? Now, the next question is, national income can be calculated either at market price or at factor cost. I repeat, national income can be calculated at market price or factor cost. Which one is better? Okay, Priya. Okay, Vasan. Thank you so much. Now, market price is the price at which the commodity is sold in the market. It is the price which is offered to the consumers at the marketplace. Whereas factor cost is the cost of factors of production. So there is a market price, there is a factor cost. For example, if I take 100 rupees to manufacture a product, for example, Vasant is a liquor manufacturer. ये 26. Vasant manufactures liquor at rupees 100. This includes rent, wages, interest, and profit. So profit is included in factor cost. So this 100 rupee product is sold in the market at 125 because there are indirect taxes. So this 25 rupees is earned to the government. 100 plus 25 is the price at which it is sold in the market. So 100 rupees is the factor cost. 125 rupees is the market price. 25 rupees that the government is getting. Did government contribute in manufacturing? Did government help Vasan to manufacture liquor? Did government provide land? Ananana. Did government provide labor? Ananana. Did government provide capital? Ananana. Did government become a partner? Ananana. Which means, can I say this is unearned for the government? And whatever is unearned should be excluded. So market price is 125. We should exclude 25. So the value should be 100. So national income should be calculated at a factor cost. A yes or no? Do you agree with me? Are we sure? Similarly, suppose if Vasant is manufacturing medicines, medicines are manufactured at 50. This also include rent, wages, interest, profit. But government offers a subsidy to the consumers of rupees 10, and therefore the price is rupees 40. So Vasant will recover 40 rupees from the market, and 10 rupees will be given to Vasant by the government. Now, when government gives Vasant, is it out of love, care, affection? No. It is for the efforts that he has put to manufacture the product. So this 10 rupees is earned and therefore it should be included. But market price excludes. So if you have to go from market price to factor cost, then you need to add subsidies. Yes or no, dear students? So what is the final conclusion? Market price minus indirect tax. Why is indirect tax excluded? Because it is unearned. Plus subsidies. Why subsidies apart? Because it is earned. So market price minus indirect tax plus subsidy is equal to your factor cost. Yes, everybody, are you all clear? So what is the conclusion? Chalo, everybody reply in the chat box. The conclusion is national income should be calculated at dash price. Market price के factor cost. Yes, everybody waiting for your reply. Absolutely correct. Very good, Priya. Very good, Faridul. National income should be calculated at a factor cost. Very good, Preeti. Now, if I tell you, Vasant, what is the formula for GDP? GDP at market price is equal to, it is C plus I plus G plus X minus M. So GDP at market price, everybody, C plus I plus G plus X minus M. C for consumption expenditure, I for investment expenditure, G for government expenditure, X for exports, and M for imports. Now this is our base formula. Then we get GDP at factor cost. GDP at factor cost is equal to C plus I plus G plus X minus M minus IT plus S. Indirect taxes are unearned, so excluded. Subsidies are earned, so included. So the shortcut formula is GDP at MP minus NIT. NIT stands for net indirect tax. Net indirect tax formula is indirect tax plus subsidies. So minus NIT becomes minus IT plus S. So the formula for NIT is plus IT minus S. I repeat, the formula for NIT is plus IT minus S. But minus NIT will become minus IT plus S. So if you are at market price, you want to go to factor cost minus NIT, that is minus IT plus S. If you want to do a reversal will be plus NIT plus IT minus S. So that is the formula for GDP at market price and factor cost. Chalo everybody, what is GDP at MP? C plus I plus G plus X minus M. What is the formula for GDP at FC? C plus I plus G plus X minus M minus IT plus S. But today we are a national economy. We don't produce only within the country. Domestic means within the country. National means within as well as outside the country. So if I am taking lectures in India, it is a part of GDP. But if I go and start taking lectures in US, then that will become a part of GNP. Domestic means within the country. National means within as well as outside the country. Now GNP's formula is C plus I plus G plus X minus M plus R minus P. R for receipts, P for payments. Shortcut formula will be GDP at MP plus net factor income from abroad, that is NFIA. So next is domestic to national. I hope everybody is understanding. Give me a reply in the chat box. It is plus R minus P, that is NFIA. And if you go over here, then it is minus R plus P, that is minus NFIA. So what is the formula for NIT? NIT's formula is plus IT minus S. What is the formula for NFIA? It is R minus P. So Vasan, the formula for GNP at MP is equal to C plus I plus G plus X minus M plus R minus P. Yes. Then GNP at factor cost is equal to C plus I plus G plus X minus M plus R minus P minus IT plus S. So it is C plus I plus G plus X minus M plus R minus P minus IT plus S. That is the formula for GNP at factor cost. So बच्चा लोग, if I have to give you a shortcut formula, what will it be? It will be GDP at market price plus NFIA minus NIT. A yes or no? Because we have gone from domestic to national. and we will go from market price to factor cost. What can be another formula? It can be GDP at factor cost plus NFIA. It can be GNP at market price minus net indirect taxes. Yes, everybody, are we clear? But all these formulas are on gross value. We want the formula at net value. So NDP at market price is equal to C plus I plus G plus X minus M minus depreciation. So what is the next adjustment? We were at gross value. We need to go to net value. Gross to net is minus D. Net to gross is plus D. So everybody, what is the formula for NDP at market price? NDP at market price is equal to C plus I plus G plus X minus M minus D. The shortcut formula will be GDP at MP minus depreciation. Now I want NDP at factor cost. NDP at factor cost is equal to C plus I plus G plus X minus M minus IT indirect tax plus subsidies. So my formula will become GDP at MP minus NIT minus D. I can also write the formula GDP at factor cost minus depreciation. Then NDP at market price. Hey, everybody, give me a reply in the chat box. Minus NIT. Hey, yes or no? Are we understanding or not understanding? Are we clear? Cannot clear? Yes, Preeti, Faridul, Vasant, Priya. In the world of changes, you are my constant. Now, I do not want NDP at factor cost. I want national product. So NNP at market price. NNP at market price is equal to C plus I plus G plus X minus M plus R minus P minus D. So formula will become GDP at MP minus D plus NFIA. I can also get it from GNP. GNP at market price minus D. NDP at market price plus NFIA. So the formula is C plus I plus G plus X minus M plus R minus P minus D. Now gross ille, net. What do we call? Yes. What is opposite of ille? What is the opposite of ille? Ille means no. Seri, seri. So gross ille, net seri. Domestic ille, national seri. Market price ille, factor cost seri. So your formula is NNP at factor cost C plus I plus G plus X minus M plus R minus P minus IT plus S minus D. Oh, Iriku, sorry. Seri means okay. So here, gross ille, net Iriku, no domestic ille, national Iriku. Market price ille, factor cost irko. Yes or no? So basically these are the formulas of measuring national income, everybody. I am giving you a Shankar Mahadevan version, breathless version of national income. What are we studying? We are studying the basic concepts in measurement of national income. GDP at market price is equal to C plus I plus G plus X minus M. But I don't want market price, I want factor cost. Therefore, GNP at factor cost is equal to C plus I plus G plus X minus M minus D. I don't want domestic, I want national. Domestic means within the country, national means within as well as outside the country. So GNP at market price equal to C plus I plus G plus X minus M plus R minus P. I don't want market price, I want factor cost. Therefore, GNP at factor cost is equal to C plus I plus G plus X minus M plus R minus P minus IT plus S. But I don't want I don't want gross, I want net. So NDP at market price equal to C plus I plus G plus X minus M minus D. I don't want market price, I want factor cost. Therefore, NDP at factor cost is equal to C plus I plus G plus X minus M minus IT plus S minus D. I don't want domestic, I want national. Therefore, NNP at market price is equal to C plus I plus G plus X minus M plus R minus P minus D. Gross नहीं domestic चाहिए, gross नहीं net चाहिए, domestic नहीं national चाहिए, market price नहीं factor cost चाहिए. Therefore, C plus I plus G plus X minus M plus R minus P minus IT plus S minus D. Whew. Are we clear? Yes, everybody. Are we all clear? Have we understood? Thank you so much, Faridul. Thank you, Preeti. So let's go to the next part. That is methods of measuring national income. Now, when I talk about methods, we call it as product method, output method, value added method, or industry of origin. So what is the formula for value added? Value added is the value of input and value of output. The difference between output and input is called as value added. So suppose if there is a farmer, the value of input is 0. But because of wind pollination and insect pollination, there is some inflow of crops worth rupees 500. So output minus input value added is 500. भाई चाबी तू कितने बजे जाएगा? हाँ मेरा 10 बजे तक है. चाबी दे देना, मैं बंद करके जाएगा. मेरे को बाद में दे दे. So now farmer has produced wheat, which becomes a raw material for a person who makes flour. Now he sold this flour for rupees 700. Output worth rupees 700. Value added is 200. Now that value added includes rent also, wages also, interest also, and profits also. So 200 value added is the payment made to the factors of a production. Now 700 ka flour is given to bakery. Bakery will further process is make it a bread. So 900. Value added is again 200. Then the bread is sold to a merchant. That merchant will sell it to the ultimate consumer for rupees 1000. So value added is 100. So total value added is rupees 1000. The final value of the product is also 1000. Few people might add all the value of output 500 plus 700 plus 900 plus 1000, 3100. But that is incorrect because this 700 includes 500, 900 includes 700, 1000 includes 900. So it will result into double counting. We do not want double counting. So what are the steps that you are supposed to follow? First of all, identify the producing enterprise and classify them into primary, secondary, and tertiary. Then estimate the gross value added. The formula for value added is equal to value of output minus value of input. Value of input is also called as intermediate consumption or purchases. Sir, what if value of output is not given? Then you can find out with the formula of sales plus change in stock. The formula for change in stock is closing stock minus opening stock. So national income is the money valuation of all the goods and services produced, not sold. So the sales value includes something which was produced in the last year, which should not be a part of current year's national income, because national income is the money valuation of goods and services produced in the current year. But sales includes a value from the past year. So you deduct the opening stock of the current year and you add the closing stock of the current year, because whatever is there in closing stock at the end of the year is produced in the current year. So whatever is produced in the current year should be a part of our national income in the current year. Deduct opening stock, because opening stock of current year is the closing stock of last year, which means this was manufactured in the last year, included in the last year, should be excluded from the current year. So the final formula for gross value added is sales plus closing minus opening stock minus the value of input. Bolo, are we all clear? Have you all understood? Give me a reply in the chat box. If you all have understood, let there be a Ramba Nalla Irka or a Lovely. So simple formula for value added is value of output minus value of input. If the value of output is not given, sales plus change in stock. Change in stock is calculated as closing minus opening stock. We add the closing stock of the current year because produced in the current year. We deduct the opening stock of the last year because it was produced, opening stock of the current year because it is the closing stock of the last year, so produced in the last year. So add whatever is produced in the current year, deduct whatever was produced in the last year. So gross value added is equal to sales plus closing stock minus opening stock minus value of input. Lovely. Now we can estimate national income. GDP plus NFIA. Then we get GNP. If you deduct depreciation, then you get net value, NNP at market price. You deduct NIT, then you will get NNP at a factor cost. Now we go to the next method, which is by the name of expenditure method. Simple formula of expenditure method is C plus I plus G plus X minus M. That's it. That is the formula for expenditure method. Now, final consumption expenditure is denoted by the letter C, which is divided into two parts, private and government consumption expenditure. All the final goods and services are included. Non-profit institutions which are serving the household. Certain non-profit organizations provide free books, free healthcare facility, free education. But that does not mean that the cost of that service is zero. So whatever is the value of the service is included. Self-consumption is included. And brokerage fee. While expenditure on foreign financial asset. So when you purchase a foreign financial asset, on that you need to pay a brokerage. GC means government's consumption expenditure. Government's consumption expenditure includes defense, health, education, productive expenditures which result into production of goods and services. Pension, scholarship, unemployment allowances are transfer payments excluded from national income. Then government's domestic capital formation. Capital formation is I. I for investment, which is further divided into gross domestic fixed capital formation, change in stock, and expenditure on acquisition of valuables. So fixed capital formation is divided into three. One is household, one is business, one is government. Only house for household, under business plant, machinery, tools and equipments, and for government roadways, schools, dams, canals, infrastructure expenditure. Then change in stock is closing minus opening stock. We also call it as inventory. And the last one is expenditure on acquisition of valuables such as work of art, jewelry. And we have net exports, that is X minus M. So the formula is C plus I plus G plus X minus M. Consumption expenditure includes two, private final consumption expenditure and government final consumption expenditure. Private final consumption expenditure is further divided into four, goods and services final, non-profit institutions serving the household, self-consumption, and expenditure on purchase of foreign financial asset. Then under government's consumption expenditure, what is included? Health, education, defense. What is excluded? Unemployment allowances, scholarship, because they are transfer payments like pension. Then comes gross domestic capital formation. Gross domestic capital formation is divided into three. gross domestic fixed capital formation, then change in stock, then expenditure on acquisition of valuables. Sir, gross domestic fixed capital formation is further divided into three: household, business, and government. Household only construction of house is included. Business, tools, machinery, plant and equipments. Government, infrastructure facilities. Change in stock is by the name of closing minus opening. And acquisition of valuables includes jewelry, work of art, Mona Lisa's painting. Net exports is X minus M. So that is your expenditure method. Then we go to the last method, that is by the name of compensation to employ, by the name of income method, distribution method, factor cost method, or dividend method. Hey, yes, everybody. Are we clear? Are we done? Now we go to the last part of this unit, that is the third method, income. See, in simple language, the formula is rent plus wages plus interest plus profit plus mixed income. Now, compensation to employees is your wages. Wages in cash, wages in kind, retirement pension, and employers. This is not employee. Employers' contribution to social security benefit like provident fund, gratuity. Then we have operating surplus. Operating surplus is rest in peace. Rent, no, not literally rest in peace. It is rent and royalty, interest and profit. And mixed income is something which is earned by a self-employed person. For example, a tailor, a cobbler, a person who owns a shop. The person who owns the shop or a tailor or a cobbler is the person who is the owner of factors of production. So a person who is self-employed earns a combination of rent, wages, interest, profit, everything. So he is termed as mixed income. So the formula under income method that we get is NDP at factor cost, which is compensation to employees plus operating surplus plus mixed income. So beta, what are the components of income method? Income method is divided into compensation of employees, operating surplus, mixed income. Operating surplus, compensation to employees is further divided into four: wages in cash, wages in kind, retirement pension, and employers' contribution to social security benefit. Operating surplus is divided into three: rent, interest, and profits. Profits can be of three types: distributed, undistributed, and corporate taxes. So if I want a profit of 1000 crore, on that I pay a tax of rupees 200 crores corporate tax. 300 crores rupees I have given in the form of dividend, and 500 crores I have kept it in the form of retained earnings. Yes, everybody. So under output method, the base formula is GDP at MP. That is value of output minus value of input. Then GDP at MP can also be written as sales plus closing minus opening stock minus the value of input. Then we have expenditure method. GDP at MP is equal to C plus I plus G plus X minus M. And beta, under income method, we get NDP because gross value is not possible. Now, we don't charge depreciation on our income, nor do we charge indirect tax on our income. So the direct answer that we get is NDP at factor cost, not GDP at MP. Yes or no? Are we clear? Then there are basic concepts like private income, personal income, and per capita income. Do we need a revision in that? Let me know in the chat box. If not, we go to the MCQs. Private income is the income of the private sector, not the income of the public sector. It can be earned as well as unearned. Personal income is the income of the household, does not include the income of government or private sector. So I think private income and personal income are quite simple to understand. Chalo, do you have any doubts? Then please let me know in the chat box. I am assuming that I have covered the most important topics from the chapter of national income unit number 1. Can you all revise private income, personal income and disposable personal income on your own? If you have questions, I am here to solve your doubts. Need not worry. Waiting for your reply in the chat box. Okay, Preeti, that's wonderful. What about others? That's wonderful, Basant. I hope you are understanding everything. Okay, Priya, thank you so much. So, Preeti, Priya, Vasant have replied. So let's complete MCQs. Then I'll give you 5 to 7 minutes to go through unit number 1. If you have doubts in unit number 1, I will solve it again. So what is your answer for question number 1? The concept of resident unit involved in the definition of GDP means what? So resident unit is that unit which has a predominant economic interest in the domestic territory. Economic territory of a country for 1 year or more, irrespective of its nationality or legal status. Next, question number 2. Intermediate consumption consists the value of goods and services consumed as inputs. Yes. So this statement is true. Then intermediate consumption excludes fixed assets whose consumption is recorded as consumption of fixed capital. So beta, can I say both statement 1 and 2 are true? Simple. GDP is something which is inclusive of depreciation. We deduct depreciation separately. So gross domestic product is inclusive of depreciation. Fourth, value added refers to the difference between value of output and purchase of intermediate goods. True. Value added represents the contribution of labor and capital to the production process. True. So answer is B. Both statements are correct. There are two types of activities, economic and non-economic. Non-economic activities are those which do not have an exchange. So your answer is B. They are produced goods and services, but since these are not exchanged in the market, they do not command any market value. Next, which one of the following is not a part of our national income? The answer is A, B, C. So D is the correct answer. They do not enter into the calculation of national income. Previously produced goods were included in the previous year. Exchange of second hand goods. Again, second hand goods are not included in national income. Stocks and bonds are financial assets. Financial assets are not a part of national income. Next, let's go to question number 7. Which of the following enters into calculation of national income? So value of services enters, stock enters, stocks and bonds, shares not entered. So your answer is D, both A and B. Next, gross national product at market price, that is GNP at MP. GNP at MP is equal to GDP at MP plus NFIA, which is your option A. So that is the correct answer. It is A. Next, choose the correct statement. GNP includes earnings of Indian corporates overseas. So Indian company working abroad is a part of national product, and Indian residents working overseas. So if I am an Indian resident working abroad, those receipts will come to India. So it is a part of GNP, but not a part of GDP, because GDP is only domestic product, whereas I gave the service abroad. So if if an Indian company or an Indian person goes abroad, gives his services, it will be a part of GNP, but not a part of GDP. Answer is A. The difference between market price and factor cost is net indirect tax plus IT minus S. Next, the net income from abroad is positive. So if NFIA is positive, GNP is greater than GDP. National income will be greater than the domestic factor income. So your answer is A. Yes, everybody. Are you all understanding? Are we clear? GDP per capita is national income divided by population. And it is the measure of country's economic output per person. So answer is D. Only Preeti is answering. Only Preeti will clear this attempt. Next, which of the following is a transfer payment? Pension, transfer payment. Old age pension is transfer. Retirement pension is not. Scholarship is a transfer payment. Floods and that is compensated is a transfer payment. So 13th, the answer is D. 14th, mixed income of self-employed means combined factor payments which cannot be distinguished, because it is mixed income is the income of the self-employed which cannot be distinguished. He gets all the factor payments in the form of rent, wages, interest and profit. Why are you unable to answer, Vasant? Didn't understand. Have you understood, Vasant? Do you want me to repeat any concept for you again? Yes, Vasant. Can I help you? Ayyo, eating ah. Next, question number 15. Which of the following is added to national income while calculating personal income? So transfer payments are added to national income while calculating personal income. Personal income plus transfer payment. Sorry, national income plus transfer payments. You have 5 minutes. Go through the entire unit number 1, and if you have any doubts, let me know. I shall be back in 5 minutes. Chalo, I am back. What are your doubts in unit number 1? No doubts. Are we all clear with unit number 1? Reply in the chat box if you want any help. Sure, everybody. Priya, Vasant, Preeti. Have you gone through private income, personal income? Hey, Bhagwan. Okay. So, unit number 2 is the Keynesian theory of determining national income. We all know that macroeconomics is related with price determination or income determination. Sir, if it's micro, then price. If it's macro, then it's income. So we have a concept called as aggregate demand. Aggregate demand's formula is C plus I plus G plus X minus M. Consumption can never be zero because there is autonomous consumption. So aggregate demand curve is an upward sloping curve above the origin. It rises from left to right. A yes or no? So aggregate demand formula C plus I plus G plus X minus M. Aggregate demand curve is an upward sloping curve. As your income rises, your aggregate demand will also rise. Aggregate demand curve cannot start from the origin. It starts from a point above the origin called as autonomous consumption. Whether you have income or not, you will still have to spend. Aggregate supply. So if aggregate demand, if I have to term aggregate demand is our expenditure and aggregate supply is the income. Aggregate supply is dependent on factors of production. What are factors of production? Land, labor, capital, entrepreneur, which is termed as NLKT. N for natural resources, L for labor, K for capital, and T for technology. Income can be zero, production can be zero, supply can be zero. So aggregate supply curve is also an upward sloping curve, but it starts from the origin. And it's an upward sloping curve. Now, where aggregate demand is equal to aggregate supply, we call it as effective demand. It is the point of income and output. So, where do we get effective demand? At the point where AD is equal to AS. Aggregate demand is equal to aggregate supply. Now, we have a gap called as inflationary gap. Inflationary gap is a situation when AD is greater than AS. So this is our aggregate demand curve. This is our aggregate supply curve. Wherever they intersect is the point of full employment and output. Now, if aggregate demand increases, it will shift to the right. So you get point E, but we cannot produce EQ1 level of output because FQ is the maximum level of output that we can produce. So the gap that is generated is called as inflationary gap. So when aggregate demand is greater than aggregate supply, there is excess demand, the price will rise at full employment level of output. That is called as inflationary gap. Similarly, in deflationary gap, this is your aggregate supply. This is your aggregate demand, where the intersect is the full employment level of output and employment. But since aggregate demand is less than aggregate supply, that means supply is more, demand is less. We call it as deficient demand. And under deficient demand, the price will fall. So aggregate demand curve will shift to the left. Equilibrium will shift to EQ1. And the gap that is created is the deflationary gap. So we have two gaps, inflationary gap, deflationary gap. Inflationary gap is when aggregate demand is greater than aggregate supply. When there is excess demand, price will rise at full employment level of output and employment. Deflationary gap is a situation at the point where AD is less than AS. So it results into deficient demand. Deficient demand results into a reduction in price at full employment. The gap created at full employment level of output is called as deficient demand or deflationary gap. Hey, yes, dear students, are we all clear? Are you all understanding? Priya, Preeti, Vasant, Faridul. If there is anybody else, please let me know. Okay, now we have to study consumption and savings function. Consumption is a function of income. Consumption is dependent on income. So if consumption is zero, if income is zero, consumption cannot be zero. We call it as we call it as autonomous consumption. Autonomous consumption is independent of income. Whereas if income increases, consumption increases. Income falls, consumption falls. We call it as B, that is induced consumption, which is dependent on income. So the formula for consumption is equal to C is equal to A plus BY. A for autonomous, BY for induced. Now if you observe, as income increases, consumption also increases, but at a diminishing rate. So what is the formula for income? Income is equal to consumption plus the savings. In savings, we have positive savings, negative savings, zero savings, and positive savings. So what is the consumption function? As income increases, the consumption also increases, but at a diminishing rate as compared to income. Then we have the consumption and savings function. So I am drawing the consumption and savings function. I can say that income can be zero. So my income curve starts from origin, rises above y. Then this is my autonomous consumption, intersects income. At the point of intersection, y is equal to c, s is equal to 0, called as break-even point. If income is equal to consumption, savings is equal to 0. This is origin, negative savings, positive savings. Now I have to draw savings curve, which I will draw in panel 2. So if this area O to A is negative savings, then I will also take the same area as negative savings in the negative quadrant. Then I will draw a perpendicular line. This is break even. When a point touches its x-axis, its y coordinate is 0. On the y-axis, we have savings. So to draw a line, I need 2 points. I will connect both of them and call it as savings. This is my negative savings. This is my positive savings. P dash is my zero savings. Yes or no? Are we all clear? Yeah, have we understood? So if you have taken this 3 lines above, this should be 3 lines below. So Vasant, this is your consumption and savings function. I am sure that you understand what is APC, MPC. So the formula for APC is C upon Y. APS is equal to S upon Y. APC plus APS is equal to 1. So APC, average propensity to consume, is the ratio of consumption to income. APS is the average propensity to save, that is the ratio of savings to income. Total consumption upon total income, APC. Total savings upon total income, APS. Then we have MPC and MPS, that is the change in consumption due to change in income. So MPC is equal to delta C upon delta Y, and MPS is delta S upon delta Y, change in savings upon change in income. So MPC is the ratio of additional consumption due to additional income, change in consumption due to change in income. Whereas MPS is the ratio of change in savings due to the change in income, or additional savings due to the additional income, and MPC plus MPS is equal to 1. Yes, dear students, give me a reply in the chat box if we are clear. Shall I go ahead to the next part? Now we need to understand the circular flow of national income under two sectors with financial institutions. So the first sector is household, the second is business firm. Household provides the factors of production to the business firm, and business firm provides goods and services. So from household to business firm, factors of production. From business firm to household, goods and services. Now household will make a payment to the business firm, so there will be expenditure on goods and services, and once the business firm receives all the payments, once the business firm receives the money, they will make a factor payment in the form of rent, wages, interest and profit. Then we have a financial institution. Households will save money with financial institutions, and business firms will take funding from the financial institutions. So this is a two sector model. The flow which you see on the outside is a real flow. The flow that is inside is called as money flow. The inner flow talks about factor payments and expenditures, so money is flowing. Whereas on the outside, it is money's worth in the form of factors of production and goods and services. Yes. So in this diagram, you just add a new curve, C plus I. See, same consumption function you need to draw. Then add the curve C plus I. So beta, aggregate demand should be equal to aggregate supply. C plus I should be equal to C plus S. CC will get cut, therefore I is equal to S. So at this intersection, savings is equal to investment. So under two sector model, C plus I should be equal to C plus S. Vasant, factor payment, rent, wages, interest, profit is in the form of money. Expenditure is in the form of money. So it is called as money flow. Is goods and services money? Is factors and of production money? No. Goods and services is real flow, Vasant. Are we clear? आजा भाई, तू भी आजा. Okay, Vasant. So, under two sector model, we say that aggregate demand should be equal to aggregate supply. Aggregate demand is C plus I, aggregate supply is C plus S. C will get cancelled, so I should be equal to S. Then we have a concept called as investment multiplier. Investment multiplier is the change in income due to change in investment. So if government spends, it will have an impact on income. The value with which the income changes is called as the multiplier. So K is equal to delta Y upon delta I. We just now studied that S should be equal to I. Therefore, delta S should be equal to delta I. Formula for S is equal to Y minus C. So formula for delta S should be delta Y minus delta C. So instead of writing delta I can write K is equal to delta Y upon delta Y minus delta C, because delta Y minus delta C is delta I, which is equal to delta S. Now divide the equation by delta Y. So you will get delta Y upon delta Y divided by delta Y upon delta Y minus delta C upon delta Y. So delta Y 1, delta Y 1. So your answer is 1 upon 1 minus delta C upon delta Y. Delta C upon delta Y is MPC. So 1 upon 1 minus MPC, or 1 upon 1 minus B, or 1 upon MPS is the formula. So what is the concept of multiplier? Multiplier represents the value of change in income due to change in expenditure or government's investment. The relationship between MPC and K is direct. If MPC is higher, K will be high. If MPC is low, K is low. So here MPC is 1, multiplier is infinite. If MPC is 0, then K is 1. Yeah, are we clear? Are we sure? Then comes three sector model. Under three sector, we have the government, and government we talk about taxes and subsidies. So see, first factors of production are given by the household to business firm, goods and services by business firm to household. Then expenditure on goods and services from household to business firm, and factor payments by household to household by the business firm. Then there are savings and investments. This is what we had already done under two sector model. Now we have government. So government expenditure and government's income, taxes and subsidies. So the government collects taxes from individual and corporates, and government spends on individuals and corporates. Government will make a transfer payment to the household, factors payment to the household, and give some subsidies. A yes or no? So beta, in three sector model, AD is equal to C plus I plus G. So AS is your income, which will be equal to C plus S plus T for taxes. A yes or no? CC will get cut. So I plus G should be equal to S plus T. So now if you see the three sector model, see this was earlier consumption function, then two sector model, then three sector model. We are just going one step above. At this point, I is equal to S. At this point, I plus G is equal to S plus T. Yes, dear students, are we clear? So earlier we studied two sector model, then after that we did multiplier value. Then we did three sector, and finally we go to the four sector. Everything is the same till three sector. Under four sector we add government. Sorry, foreign sector. So what does the household give to foreign sector? It can give manpower services, it can remit money. So remittance. So what is the equilibrium? See, now you have basically understood the base. Concept should be clear. So under four sector, we get C plus I plus G plus X minus M should be equal to C plus S plus T. Aggregate demand should be equal to aggregate supply. Now I can write this as C plus I plus G plus X is equal to C plus S plus T plus M. M will go on the other side of equal to become positive. C will get cancelled. Therefore I plus G plus X should be equal to S plus T plus M. Now there are two possibilities. Now this was consumption function, then this was C plus I, then this is C plus I plus G. Now you have C plus I plus G plus X minus M. So if exports are greater than imports, three sector income will be less than four sector income. Because under three sector we have only C plus I plus G, whereas under four sector we have exports, and exports are greater than imports, so the flow of money is more. So three sector income is greater than four sector if X is greater than M. But what if X is less than M? Then three sector income will be greater than four sector income. Yes or no? Have we understood? Are we all clear? Do you have any doubts, any queries? If not, then we'll go to the MCQs. Vasant, Priya, Preeti, Faridul, and others. So let's complete all the MCQs. Then I'll give you 5 minutes time to go through. If you have doubts, then we will solve those doubts. If not, then we are done for the day. Tomorrow's class we will do public finance. I hope you all are aware that tomorrow's class is in the morning. We will be meeting tomorrow early in the morning. Please make sure that you come at, I think the lecture is at 9 or 9:30. Just get it confirmed. Chalo. In the Keynesian model, timing you can ask at Thankyou. I think it's either 9 or 9:30. I don't recollect actually. Yes, Preeti, thank you so much. So, in Keynes model, equilibrium aggregate output is determined by aggregate demand. So, your answer is A. Keynes believed that economy may attain equilibrium level of output at below the full employment level of output. So according to Keynes, not necessarily full employment is the equilibrium level. You can receive it either at full employment or below full employment. Next, according to Keynes, consumption expenditure is determined by consumption. C is a function of Y. So I think it is disposable income. Your answer is C. A yes or no? Are we clear? So let's go to the next one. MPC, marginal propensity to consume, is the change in income, change in consumption due to change in income. So your answer is A, change in spending due to the change in income. Very good, Vasant. Keep it up. Chalo, fifth. If the consumption function is C is equal to A plus BY, what does the letter B represent? B represents marginal propensity to consume. B is MPC. Then in consumption function C is equal to A plus BY, what does A represent? A represents autonomous consumption. Yeah, are we clear? If consumption function is equal to 20 plus 0.5i, then increase in disposable income by 100 will increase the consumer expenditure by. So C is equal to 20 plus 0.5 into 100. C is equal to 20 plus 50. Therefore C is equal to 70. Vasant, in question number 7 your answer is wrong, because they have asked you increase in consumption expenditure delta C. If you say the answer is 70, that is the total expenditure. But they have asked you by how much. So by how much will be option C. Am I clear, Mr. Vasant? Any questions, any queries, any doubts? Next, if autonomous consumption is 2000, so C is equal to A plus BY. C is equal to 2000 plus 0.8 into Y. They have given that income is equal to 1000. So C is equal to 2000 plus 0.8 into 1000. Now they have asked total consumption, Vasant. So C is equal to 2000 plus 8000. Therefore C is equal to 10,000. In the Keynesian cross diagram, the point of aggregate demand function crosses the 45-degree line. So equilibrium level of income may or may not be at full employment level. Because Keynes believed that equilibrium can be achieved even before the full employment. In a closed economy, the formula is C plus I plus G. Consumer expenditure C. Investment expenditure I. So beta Vasant, the answer given is 10,000. Correct. Total is 10,000. Additional is 8,000. Vasant, are we clear? Next, question number 11, which is the last MCQ. Multiplier K is equal to 1 upon 1 minus MPC. 1 upon 1 minus 0.8 is equal to 1 upon 0.2, which is equal to 5. So your answer for question number 11 is C. 5 minutes. Go through Unit 1 and Unit 2. If any doubts, please ask. I'll come back in 5 minutes and get your doubts cleared. All right. Sir, but while writing the sum, you had written 1000, is it? Oops, sorry. This is 10,000, my friend. Chalo, do we have any questions, any queries, any doubts? Please let me know in the chat box. Everybody, do we have a doubt? Or are we done? No doubts? Okay. So that's it from me today. Thank you so much. Please like, share, subscribe, comment, hit the bell icon. Bye bye. I'll see you tomorrow. Did anyone confirm the time? Was anybody able to confirm tomorrow's time? It's in the morning for sure, but whether it's 9 o'clock or 9:30, I'm not able to recollect. 42, thank you. Was anybody able to connect to the academy? Thank you, Preeti. Good night. I hope you understood the lecture. Okay, Priya. Thank you so much. Bye bye. Okay, Preeti. Do let me know. Okay, Vasan. No problem. That's wonderful, Vasan. Thank you. Chalo. So that's it from me today. Thank you so much. Bye bye. Take care. Do like. Lovely. Arey, Vasant. Chalo. Bye bye.